All right, everyone, we're going to go ahead and get started. Thank you so much for being here. I have Mark Chaikin here with me today. Mark, how are you?
I'm well, Mark. Pleased to be introducing you to the Chaikin community once again.
Thank you so much. I appreciate always being part of the Chaikin community. I have a lot of respect for you guys.
Well, thank you. Why don't I kick it off by giving my unique perspective on options moneymaker and Mark Dannenberg.
Sounds great. Go ahead.
Welcome, everybody. Today's guest webinar presenter, Mark Dannenberg, has really resonated with the Chaikin community, which has increasingly become an options-oriented community. What I find unique about Mark is that he spent 26 years in senior management at a Fortune 500 company, so he brings real-world corporate experience, knowledge of how companies run their businesses, how they report their earnings, and how that all relates to stock prices. In addition, he's got 26 years of personal experience trading options, and he now has dedicated himself to teaching, which I find to be the highest calling of all, showing people how to create strategies, coaching self-directed investors with a particular focus on options and generating income from options positions. In this afternoon's webinar, Mark is going to tell us about how he's helped the options moneymaker clients in the trading room manage their positions subsequent to the extreme volatility that we experienced on August 24th, 5th, and how his clients have actually protected their capital and their profits in what has been a very challenging time for investors and traders. So with that, it's my extreme pleasure to introduce my friend Mark Dannenberg, who I think will give you a really information-packed webinar this afternoon.
All right, Mark, well, I appreciate that introduction. Again, it's always a pleasure to work with you and the people from the Chaikin community. So what I want to talk about today is the art of trading. We really focus our attention on helping people learn how to simplify their trading and grow bigger profits. If you're a brand new trader, we've got some content for you today that I think you may want to pay attention to. If you're an experienced trader who may just need a little more help in understanding how to be more consistently successful, we've got some content for you also. And I'd like to do my best today to give you some takeaway points, some things that will help you be a better trader. So Mark touched on this. I was a senior executive for 26 years, Fortune 500 company. Worked for ADP for 26 years and ran divisions for them. I loved what I did. I genuinely loved what I did. I enjoyed working with the people that I did. I enjoyed training teams of associates and leaders and junior executives. Really enjoyed it. But I knew along the way that I had a strong desire for lifestyle freedom. I traveled extensively when I was working in corporate America, and I enjoyed it, but I knew that at some point I may not want to do that anymore. And I always thought there had to be a way that I could design a lifestyle for myself that would allow me to earn what I would describe as an abundant income and still have complete flexibility to work from wherever I chose, travel as much as I want, and still be able to work. So I started trading as a hobby, and I did so for about 20 years. The last 10 years I've been teaching, but in the first few years that I was trading, it was kind of fun. You know, it was kind of more like gambling. It was a distraction for me. It was entertaining. I started to realize that if I got really serious about learning this, that it actually may allow me to achieve that lifestyle freedom that I had thought might be achievable. And so I started to get very serious about learning how to trade. I learned a lot about what not to do, and I learned a lot about what to do. And that led me to, in 2009, I founded Options Moneymaker. As I was leaving my corporate America job, many of my social network friends and my professional network friends asked what I was going to be doing. And when I told them, they asked how they could also learn how to do that. So that led to me starting to teach. And in 2009, I founded Options Moneymaker to formalize that and to help other traders learn the art of trading. I am a very active trader. I am active in the markets every day. I host a live trading room every day. So when I talk about trades and I talk about strategies and I talk about modifying, adjusting, managing, and navigating your way through the market, it's based on real-time trading, not something that maybe I did 5 years ago and just continue to regurgitate the same thing. So I do love to teach people, and it's one of my favorite things. I actually come from a family of educators. My father was a college professor. My mother taught school. My sister got her degree in education, and I was kind of the black sheep because I was in corporate America, but I've kind of transitioned all the way back now to being a teacher, and it's really what I love to do. I love to see people succeed at something they have a desire to learn. And ultimately, I was able to achieve and enjoy that lifestyle freedom that I had a dream about and was able to accomplish that. Fortunate enough to live in California, on the north coast of, on the north side of California, just south of San Francisco, in a right on the beach, and that's what I love about my lifestyle freedom. So let me see what I can do to help you guys perhaps achieve whatever goals you have. So today's session is being recorded, and we're going to send out a copy of it tomorrow. Before we get started, let me just say I will take questions at the end. If you do have questions during the presentation, feel free to put them in the question box, and I will look at them at the end. Many times, majority of the time, the questions that are asked early in the presentation are actually answered towards the end. But if you don't want to forget your question, please feel free to put it in there. So let's start with, first of all, who I think today's presentation is going to be most beneficial for. Beginning traders who are looking for a way to get started. If you learned the basics of options and you have kind of a basic concept of what options are, you understand the basic characteristics of options, that there are puts and calls, that there are expirations, that there are strike prices that you need to understand. If you understand that, but you don't really know where to get started, please stay tuned, because I think that what we offer is a great opportunity to get started and have someone help guide you through that learning curve of trading options. Experienced traders who are looking for greater success, lots of experienced traders out there, people who may have had short periods of success and then they donate a lot of profits back to the market. If you just like to learn how to trade more successfully, more consistently, or even simplify your trading if it's become too overly complex for you, stay tuned. I think we have an approach that may be something you'd be interested in. Anyone who's committed to learning a lifelong skill will benefit from today's presentation. This is all about knowledge. Knowledge can never be taken away from you. As long as you have enough capital to get started trading, any point in your life, if you retain this knowledge, if you develop a skill set based on this knowledge, you can be successful at generating an income. And then traders, specifically traders who are seeking a simpler way to trade and earn, minimize fear and grow a big account. You know, fear is so prevalent in trading, and it's some of what we focus on to try to help people overcome. I don't want to have my lifestyle freedom diminished by fearing the market and being plagued with anxiety and overcome with just that discouragement. I want to trade on a very stable emotional level, and that's what we teach our traders how to do. All right, so the core strategy that I'm going to talk about today is credit spreads. Now, credit spreads are a very simple directional strategy. They, in my opinion, are one of the simplest directional strategies that is available to traders, and it's one of the best spread strategies for new traders to start out with. But here's the reality, folks. It's a simple strategy, but many traders fail trading credit spreads. And it's really not necessary. And generally they fail because of improper selection of strikes. They just do not select the proper strikes when they're constructing a position. They have insufficient time built into their position. Many people try to trade right up at expiration and they have no time, no wiggle room if the market moves against them. They have a very naive assessment of risk. And generally, I would say most traders, especially newer traders, will put too much risk on. If the risk that you have in the market is causing you sleepless nights, you need to take that risk off. If the risk that you have in the market, if you were to lose that money, would change your lifestyle, you need to take that risk off. There are so many variables that will help you decide how much risk to put in play, but we actually help guide people to understanding what the proper amount of risk is, what the true risk is. And we don't want people to worry about their money. We just want them to make money. And then the last reason that people fail is no adjustment strategy. Mark mentioned August 24th, August 25th. It was a very, very volatile day on August 24th. Unprecedented move in the market. We trade typically the major indexes, NASDAQ 100, S&P 500, and the Russell 2000. If we had not had adjustment and management strategies, we would have been like so many other traders who would have just donated a lot of our profits back to the market. But we didn't. And here we sit 2 months later, having navigated our way through that challenge, having retained all of the profits that we had accumulated prior to August 24th. And that, I believe, is a testament to the adjustment strategies that I believe every trader needs to learn. Knowledge of how to properly manage a position and manage your portfolio is going to significantly improve your overall success. So the topics I'm going to talk about today are how to trade credit spreads with minimal true risk, understanding what that true risk is. We're going to talk about the forgiveness factor, and we're going to talk about building time into each position. We're going to talk about proper selection of strikes and expirations. We're going to start with a very, very simple, very basic approach to understanding where you should place your strikes for maximum opportunity. We're going to talk about how and when to adjust a trade. I'm going to give you an example of that. And we're also going to talk about how to grow a bigger account, how to properly compound your account to grow a bigger account. This is all about starting small and growing big. All right, so let's first of all start with a definition of the forgiveness factor. The forgiveness factor is essentially a component in constructing a new position that says when the price moves against your position, you can still make a profit or break even. When the price moves against your position, you thought that the stock or index you're trading was going down and you opened a declining bias position. When the price moves against your position, you can still make a profit. That's the forgiveness factor. It's about placing natural barriers between the current price and your risk strike. Risk strike is something I'm going to define for you here in just a moment. But you want basically a forgiveness factor that says if the stock or index moves in the wrong direction or your timing is wrong on that directional move, you still have an opportunity to win. That is a key to being successful with trading credit spreads. So here's an example of a credit spread trade. This is a trade that was done on NDX. That's the symbol for the NASDAQ 100 index. These are not futures contracts. This is not the ETF, the Qs that tracks the performance of NDX. This is trading options on the NASDAQ 100 index. The index was trading at 45.30 during May week 1. We saw that there was a declining bias in the index. We felt like the index was going to move lower from its current price. To take advantage of that, we opened a call credit spread. Now, a call credit spread is constructed by putting together two legs, two strikes. We sell to open one strike, and we buy to open a second strike. The strike that we sell to open is always going to be closer to the current price of the index than the one that we buy to open. That means that the one that we sell to open has more value than the one that we buy to open. When we sell to open one leg and buy to open the next leg, it creates a net credit into our account. So specifically, this trade was constructed by selling to open a May week 3 NDX NASDAQ 100 45.95 call, and we took a credit into our account for that. And simultaneously, we bought to open a May week 3 NDX 4600 call. Now, time is a factor in building our positions also. We generally build 2 to 4 weeks to expiration in our position. We want some time in our position in case we're wrong on our directional assessment. Now, those of you in the Chaikin community understand that a good portion of what Chaikin Analytics does for you is it helps you determine which direction a stock or the market overall may be moving. And so you have a huge advantage because the Chaikin Analytics are very precise in determining which direction it may be moving. But we always like to give ourselves a little bit of an out, and that is the forgiveness factor and time. So first of all, if it was May week 1, we opened a May week 3 position expiration. So this position has 2 weeks to expiration. Generally 2 to 4 weeks is our appropriate time frame. The forgiveness factor is that we constructed a position that could actually move against us. It could move 65 points against our position, and we could still win. All we care about when we construct a call credit spread is that the price of the index remain below 45.95. So it could move 65 points higher, and we would still have a winning trade. So when we built this trade, we took an overall credit of $1.60. That means that we took a big credit on the 45.95, we paid a debit for the 4600, and the net of those two was $1.60 of credit. Now this is where we talk about assessing your risk, and this is where most people don't know how to size their risk. On a credit spread, the maximum risk you have is 5 points in this particular spread. The difference between the strikes is your risk. In this case, the difference between the strikes is 5 points, so our maximum gross risk is 5 points. But since we took a credit of $1.60 when we opened this position, our actual net risk is $3.40. Now, it's the $3.40 of risk that you as a trader need to use to then decide how many contracts do you want to open? What size of a position do you want to put in play? And generally, people feel really good going in, and it's not until something starts to go haywire with their position do they realize that maybe they put too much capital into play. A lot of people were realizing that post August 24th, that perhaps they had too much risk in play. But you want to use the $3.40 net risk number because that's the maximum amount you can actually lose to decide how much risk you want to put in play. If I opened 10 contracts, each contract represents 100 shares. 10 contracts would be a $3,400 risk. So depending on the size of your portfolio, depending on your risk tolerance, you would decide the number of contracts that you want to trade. This trade is set up to benefit from a move down, and the maximum profit is equal to the credit that we took. Maximum profit would be $1.60. It's set up to benefit from a move down, but it has this forgiveness factor of 65 points. So even if the index moved up another 65 points, we still, 2 weeks after we open the trade, could possibly win on that trade. Now, the factors that we considered in choosing this trade, choosing the strikes and choosing the expiration, were NDX, just prior to this, had traded to its highest high in 15 years. Its highest high at that point was 45.62.33. That was a 15-year high. Now, we put our risk strike, so if I back up just a minute, our risk strike is 45.95. It's always the leg that we sell to open. We want the price to remain below that, so we consider that to be our risk strike. We placed our risk strike 33 points above the 15-year high. Is actually an all-time high with the exception of March of 2000. 15-year high. Now that doesn't guarantee that the price is not going to move higher, but in our experience we find that when you have new highs, new all-time highs, new multi-year highs, they act as a natural level of resistance. So that's resistance level number one. We would need to move 33 points up and then move above that 15-year high before we would encroach on our risk strike. So the second thing is, for our very, very simple charting, this is to help people get relaunched if you're an experienced trader, or get started without an overwhelming number of technical indicators to look at. We use Bollinger Bands. We use 2 and 3 standard deviation Bollinger Bands. Very, very simple, and I'm going to show you a chart here in just a second. The 3 standard deviation Bollinger Band was at 45.80. Now our experience is that on these indexes, the price has a tendency to bounce like a pinball back and forth between upper and lower Bollinger Bands. Knowing that the 3 standard deviation Bollinger Band was at 45.80 tells us that the price would have to move significantly higher than the Bollinger Band, and that is generally not what the indexes do. Now, there's nothing in trading that is 100% guaranteed or absolute, but when you start playing with the Bollinger Bands and understand how the price works relative to the bands, you're going to understand why that makes this a very, very secure and confident trade. Our risk strike was 15 points higher than the 3 standard deviation Bollinger Band. And then we also use support and resistance. So we use Bollinger Bands and support and resistance. And we had 2 levels of resistance between the current price and our risk strike. And then of course we had 3 weeks to expiration. It was about 2.5 weeks to expiration actually, which means if the price of the index did in fact move higher instead of lower, if we were premature in the entry of our position, and price continued to move higher before it moved lower, that gives us time to adjust and manage the trade. So here's a very simple chart view of the pattern and where we placed our position. So first of all, our risk was at 45.95. That's the horizontal right here. So visually you can see how our risk strike was sitting pretty much above the market. It was sitting above where the market was trading. At the time, using just very, very simple support and resistance, we saw a declining level of resistance. And so what we're anticipating is that if that declining level of resistance held, that the price may in fact move up to resistance and then continue to move lower. So that by itself was a barrier that the price would need to move above before it would ever encroach on our position. We also had the new high on the 27th of April, 45.6233. So if we did move above resistance, we would then also need to move above that high and form a new 15-year high, which absolutely we knew that could happen. But that was a second level of resistance, second barrier between where the current price of the index was trading and our risk strike. And then the Bollinger Bands. The Bollinger Bands are these blue lines that weave their way through the chart. Now, if anybody wants to just start out with very, very simple technical trading, I highly recommend getting acquainted with the Bollinger Bands. It's one of the most reliable technical indicators out there, in my opinion, especially when trading the indexes like the NASDAQ 100. If you just look over this time period that I'm showing, and you could pull up any chart and see the same thing in whatever time period, the price has a tendency to move back and forth between the upper and lower Bollinger Bands. Now, there are time periods where it will hold along a upper or lower band for a period of time before it reverses and moves lower. That's okay. Not everything in what I'm describing to you is 100% guaranteed to be consistent. It's just saying that there's such a high degree of reliability in our experience trading the Bollinger Bands as a very simple approach that we tend to take almost every Bollinger Band trade. There are also indications where when the price exceeds the Bollinger Band, meaning it moves outside the 2 and or 3 standard deviation band, that it increases the likelihood that there is going to be a snap back inside the Bollinger Band envelope. So when I see a price point like this one on the 17th, that would be a trigger to go ahead and take a rising bias trade, because I'm expecting that very soon we're going to see a price snap back higher. This is a 30-minute bar chart, so there we were just a few hours later and we saw that snap back higher. So knowing that a movement outside the Bollinger Bands will generally prompt some sort of a reversal in the price, having our risk strike above the 2 and 3 standard deviation bands gave us yet another level of security for that trade. So in order for this trade to be threatened, if it moved against us, we'd need to move above the declining resistance, the 15-year high, the 2 and 3 standard deviation Bollinger Bands, and we would need to move above the long-term rising resistance. And if that all happened, then we would need to manage or adjust the trade. This trade uses time. We built 2.5 weeks into the trade, and it uses a forgiveness factor. We built 65 points of forgiveness factor into the trade. Now, the number of points of forgiveness is not always the same. It's different by index to index, and it's not always the same on every single position. It depends on where the Bollinger Bands are. It depends on where support and resistance are. That's the primary way that we are going to define where we place our strikes and how much of a forgiveness factor we build in. These trades are simple to identify, and the credit spread strategy is very simple to set up. We automate our trading then after that by setting a good till canceled order to close for a profit. You see, we're going to do the hard work 15 to 30 minutes a day. We're going to look at the charts. We're going to look at the Bollinger Bands. We're going to look at the strikes, look at the credits. We're going to open a position, and after that, we want to automate our close because we want to be out on the beach, out on the golf course, out on the motorcycle, at our job, at our business. We want to do whatever else life demands from us, and we want to automate our close. So we generally, in our experience at Options Moneymaker, we generally find that a 10% return on each position, 10% of the risk that you have on the position, is a good guideline. That tends to be the sweet spot. If we can grab a 10% profit, then we can take our capital, recycle it by opening another trade, and we can compound our profits. This is right here an outstanding way to grow a big account. We don't hold on for all of the credit to be our profit. There are far too many times in my experience in the early days where I had a very, very nice profit, but I wanted to hold on for more, and then the profit evaporated. And then the profit came back again, I'm holding on for more, and then the profit evaporated. My experience is the sweet spot is a 10% return based on the gross spread, gross risk. So that's 50 cents on a 5-point spread. And then when the cycle moves back in the other direction, you open the same trade or a different trade again. And you just repeat and compound, repeat and compound. If you allocate 15 to 30 minutes a day to your trading, you start by reviewing your charts for possible new trades, and you review existing positions for whatever actions may be taken. That's really all you need in order to trade successfully. Now, the really cool thing about the credit spread strategy is it can be used to create a non-directional position also. Credit spread is a directionally biased strategy, but it can be used to create a non-directional strategy. And when we do that, it's called an iron condor. The way we open an iron condor is we just simply open both a call credit spread and a put credit spread simultaneously. Call credit spread and a puts credit spread. Now, if we open a call credit spread, we have a declining bias trade. If we open a put credit spread, we have a rising bias trade. So we have two competing trades, or if the strikes are constructed properly, you actually have two complementary trades that both trades can actually win. It eliminates the need to assess the directional bias. You can open an iron condor at any time, and if for all practical purposes, you don't really care which direction the index moves. You're going to have a profit regardless of price movement, guaranteed. This is guaranteed, folks. You're going to have a profit regardless of price movement. One side is going to absolutely be guaranteed to win on a move because you will have a profit on either the call or the put spread, depending on which direction it moves. And the other side, the one that the price is moving against, is still going to benefit from the forgiveness factor. So if you open an iron condor and the price moves higher, you're going to have a profit on the put spread, and the call spread will benefit from the forgiveness factor. Setting up an iron condor using simple Bollinger Bands as a guide for choosing strikes is a very, very simple way to trade. And there's a common theme in what I'm presenting to you tonight. It is simplicity. We want to, as much as possible, keep our trading simple so that we can go enjoy our lifestyle freedom. We want to, as much as possible, teach traders, other traders, as many traders as possible, how to trade simply so that they're not overwhelmed and feeling as though they're lost. One of the ways we simplify our trading is we really only trade, for the most part, three indexes. We don't trade stocks extensively. We don't trade ETFs. We trade three indexes. We trade the NASDAQ 100, that's NDX. We trade the S&P 500, that's SPX. And we trade the Russell 2000, that's RUT. Now these indexes have very clearly identifiable and consistent cycle patterns. They cycle up and they cycle down. And just when you think that this index has moved against your position to the point where you might have to do something with it, you see a reverse cycle, because you can always 100% of the time count on a contrary cycle. You don't know when it's going to start, and you don't know how long it's going to last, but guaranteed there will always be rising cycles and there will be declining cycles. We love trading these three indexes, and we find that if we focus on these three, we become intimately familiar with the patterns of these indexes, and it's easier for us to recognize when to open or close a position. When you're opening an iron condor, you can either open both sides, the put and call, at the same time, or you can leg into each side as the index cycles. So if you're at the top of a cycle, you could open a call spread, a declining bias trade, and then as the index moves lower, you could open a rising bias trade and then end up with an iron condor. This is an excellent way to grab profits regardless of which direction the index may be moving. So let me walk you through an example of a trade leveraging cycles to leg into a trade on the Russell 2000 index. RUT is the symbol. On April 8th, we sold to open a 1280, 1285 April week 4 call. Now, we had about 2.5 weeks to expiration. The index was trading around 1260 at the time that we opened this. So we built a 20-point forgiveness factor into this trade. And I'm going to show you the chart here in just a minute. We built a 20-point forgiveness factor into this trade, and we had 2.5 weeks to expiration. So the 2.5 weeks fits right into our 2 to 4 week model. And the 20 points of forgiveness, it was clear because it's based on what we saw on the chart. So I'm going to show that to you in just a minute. We took $1.40 of credit. The following day, on April 9th, we bought to close that 1280, 1285 call. We took a profit by giving back 80 cents of the $1.40 of credit we had originally taken on the 8th of April. When we gave back that 80 cents, it locked in a 60-cent profit for us. Now, I told you before that we calculate our percentage returns on the gross risk, the gross risk. It's a very conservative way to look at your percentage returns, and we tend to be conservative. So 60 cents on gross risk of 5 points on the spread is a 12% return, and we held that for one day. That same day on the 9th, we sold to open an April week 4 put spread. This is a rising bias put spread, sold to open the 1230 and bought to open the 1225. Well, now what had happened is RUT had moved down about 10 points. It was trading around 1250. That's what allowed us to close the call spread and take a profit. And then we turned right around and recycled that capital immediately into a new trade. Still about 2.5 weeks to expiration, and we still have a 20-point forgiveness factor. It's just that now it is, if the index moved 20 points lower, we could still have a profit. We took $1.12 of credit on that trade. What was interesting is that day, the index moved back higher again later in the day. And later in the day, we sold to open the same call spread we had closed out earlier that morning. We sold to open the 1280, 1285 April week 4 calls. And we took $1.30 of credit, just 10 cents less than what we had taken the previous day, but 50 cents more than what we had closed it for earlier in the day. At this point in time, we have now legged into an iron condor. We have both a put spread in play and a call spread in play. And what defines it as an iron condor is both the puts and the calls have the same expiration. They have the same spread distance between the short strike and the long strike, and they have the same number of contracts. If those factors are all aligned, then you have an iron condor. Now, what makes an iron condor unique and kind of a cool strategy is you have 5 points of spread risk when you hold the puts or calls, but you still only have 5 points of spread risk when you hold both. And that's because everyone knows it is impossible for you to lose and actually have risk on both spreads at the same time. I cannot possibly be trading above 1280 and losing on the calls while simultaneously losing on the puts. I can't be below 1225 and above 1280 at the same time. So when you open an iron condor, It's like getting a free bonus credit. We got $1.30 of credit from the calls that we add to the $1.12 that we took on the puts. So it's $2.42 of total credit, but it still is only against the 5 points of spread risk. So the iron condor reduces significantly the amount of total risk you have in the trade. We went from $3.88 of risk on a 5-point spread to $2.42 of credit, meaning $2.58 of risk. So we reduced our overall risk on the trade. And we set ourselves up so that we didn't really care which direction the index moved. On the 10th of April, we bought to close the puts. The index continued to move higher. We paid 60 cents to close the puts. That was of the original $1.12 of credit that we took. And on the 17th of April, we then closed out of the call spread. We paid 40 cents of the $1.30 we originally took in and locked in an additional profit. So the summary of the trade, having legged into an iron condor, is that we were in the trade for 7 trading days, 9 calendar days. We took a total of $1,010 of profit. Now that was $2.02 of profit, and we were trading 5 contracts, so that represents 500 shares. That's a 40.4% return on the 5 points of spread risk. Now the reality is, because we have a credit in here, the percentage return is actually much higher because we're not actually taking into account the benefit of the credit. We like to be conservative and we keep it very simple. 5 points of spread risk, that's how we calculate our percentage return. What really matters is this right here. I can't spend the percentage. I can spend this. A lot of people talk about their percentage returns. It's such a fun thing to do. It gets everybody all excited. Big percentages. Well, at the end of the day, all that matters is what you can spend. So how you calculate your percentage is up to you. We tend to be very conservative on the way we calculate ours. This is all about opening positions and closing positions on the cycle movements of the index. And then we take our capital and we recycle it, put it back to work immediately so that we can generate bigger returns against the same capital. So here's a chart showing exactly what I just walked you through. Here's where we sold to open the call spread. Right here, we were trading right near the upper Bollinger Band. And then the price moved lower, and we saw that the price actually moved below the lower Bollinger Band. That is a clear indication to us that there is most likely going to be a bounce back higher. So that would be the time for us to take a profit on the call. If we're going to bounce back higher, I don't want to still be in the call. That's also a time for us to open a put spread, because I want to take advantage of what I consider to be the likelihood that we're going to see a bounce back higher. So that's what we did there. We bought to close the call spread and we sold to open the put spread. Now, we sold to open the call spread again later that day. As I said, I think in hindsight, we were a little premature on that. We should have probably waited because we were right in the middle of the Bollinger Bands. But I do remember that the driving factor was we were able to open that call spread for just 10 cents less than what we had opened it for the day before. So we went ahead and opened that, and that's when we held the iron condor. The index continued to move higher, and that's where we ended up buying to close the put spread as we're getting close to the upper Bollinger Bands, and we had a very healthy profit. Index tracked along sideways, moved a little higher, moved lower, bounced back and forth between the Bollinger Bands until a week later we saw a more pronounced move lower, and that's what allowed us to exit out of the call spread. This is all just very, very simple trading. When you recognize how easy it is to trade just purely off of the Bollinger Bands, you'll recognize that you can get into positions very easily, get out of positions very easily, and start generating your own big profits. Now, sometimes even when there's a forgiveness factor and time built into the position, it needs an adjustment. Sometimes everything doesn't work out the way we would like it to. And there are 3 simple ways to adjust credit spreads. This will take care of 95% of the adjustments. Now, there was an exception in August, on August 24th and after. We needed to use some more advanced management techniques that typically we use only in our live trading room, but we did incorporate those into our starting traders curriculum because we wanted to help people retain their profits and successfully navigate through that unprecedented move. And we did just that. And I'm going to share with you here in just a minute where we are to date in terms of absolute performance. And we're pretty proud of it. But sometimes you need to manage or adjust. And there are basically three simple ways to adjust a credit spread. One is a rollout. And a rollout is where you move the expiration out in time so that you add more time to the trade. The worst thing to me in trading options is when I'm right, but I run out of time before I have an opportunity to benefit from my correct view of which direction the market's moving. So you can roll out in order to add more time to the trade. You can also reposition. Sometimes you find yourself with the strikes in the money, and you can reposition so that your strikes are no longer in the money. And then the third approach would be to do both, roll out and reposition at the same time. That's where you adjust the expiration and adjust the strikes. Now, let me just touch on the concept of being in the money on a position. One of the reasons we like trading the indexes, people ask me all the time, well, why don't you trade this or that? Why don't you trade the ETFs instead? One of the reasons we like trading the indexes is, again, because we want to keep it simple. And one way of keeping it simple is eliminating fear and anxiety of losing control over my trade. And one of the ways to do that is trade the indexes because they are European style expiration. European style expiration options can only be exercised or assigned at expiration. ETFs and stocks are American style expiration, and they can be exercised or assigned at any time leading up to expiration. So if I hold a position that is 2 weeks to expiration and I find my position in the money, I'm at risk every day of being exercised or assigned. Kind of depends on how deeply in the money I am. With my NDX, RUT, and SPX trades, I don't lose a wink of sleep if my position is in the money. I have plenty of time to figure out what I want to do with that trade because I'm not going to have that trade taken away from me unexpectedly through an exercise or an assignment. These are simple management moves to execute. Generally, they require a very small amount of capital. So people are generally concerned about the magnitude of capital that is required in order to manage, and they're very simple to execute. Now, how do you know, though? This is one of the complexities of trading, is how do you know when it's appropriate to take action, when I need to take action? And what we've done at Options Moneymaker is, over the years, we've kind of boiled it down to three very simple questions. And if you can view your positions every day, do a complete review, and answer the following three questions each day, you're going to have a very clear understanding of whether or not now is the appropriate time for you to take action. Question number one, is there a profit? Well, if the answer is no, there's nothing else to do. There's nothing else to do if you can't take a profit. If you do have a profit, now it's entirely up to you whether or not it's a profit sufficient that meets your needs or your objectives. As I already told you, my objective is to trade for about a 10% return. Question number two, is the risk strike in the money? That strike that you sold to open, if it is not in the money, there is no action required. You want it to be out of the money, and if it still is out of the money, then there is no action that is necessary. If it is in the money, then it may require a reposition, possibly a rollout, but mostly a reposition. And then the third question is expiration less than 1 week away? And if the answer is no, there's nothing else for you to do. If the answer is no, I don't have a profit, my risk strike is not in the money, and expiration is not less than 1 week away, I'm done. There's nothing else I need to do on that position. I don't need to start anticipating what the position may or may not do. That's when there is a level of complexity that you can't possibly figure out. Just keep it very simple. You're not making a decision on what to do with this position 5 days from now. You're making a decision on what to do or not to do with this position today. That's it. If there is less than 1 week away, if the position is less than 1 week away from expiration, then most likely it needs to be rolled out. So if you have a profit, maybe you want to take it. If not, leave it. If your risk strike is in the money, you can reposition it. If your expiration is less than 1 week away, roll it out. It really boils down to being very, very simple. So let me just walk you through an example of a trade where we ended up having to manage the trade. And then I'm going to summarize for you and take questions. This is on NASDAQ 100. It was trading at 43.80 at the time that we opened an iron condor. We did not leg into this iron condor. We just opened both the calls and the put spreads at the same time. This was on the 30th of March. We opened the 44, 45, 44.50 April week 3 call spread and the 4,300, 42.95 April week 3 put spread. Here's the total credit we took on each side. We have about 2.5 weeks to expiration. There's a 65-point forgiveness factor on the calls. That's the difference between our risk strike of 44.45 and the price of the index at 43.80. And there's an 80-point forgiveness factor on the puts, 43.80 versus 4,300 put risk strike. On the 2nd of April, we closed the call spread. The price of the index had moved lower, and we paid 65 cents to buy back that call spread, leaving us with a $1 and a penny profit. On the 6th of April, the index had moved back higher again, and we reopened a call spread. Now, we didn't use the same strikes we had originally used, but our strikes were still higher than the put strikes, and they were the same expiration, and it was the same number of contracts, so we were right back into a iron condor again. And we opened the 4,400, 4,405 April week 3 calls for $1.50 of credit. On the 9th of April, we bought to close the 4,300, 42.95 puts. So we closed out the puts. We paid back 50 cents of the $1.17 that we originally took in. Now on the 10th of April, the index continued to move higher, and it moved above 4,400. And that was the risk strike that we held on the call spread. And we decided it was now necessary to manage the trade. We assessed we assessed the directional bias of the index at the time, and we determined that although we had moved above our 4,400 risk strike, that it was likely that we would see a declining cycle on the index and that we would trade back below 4,400. But we were going to run out of time on the position. We only had a week to expiration, and so we were going to run out of time. And so what we did was we bought to close the April week 3 calls, and we sold to open the same strikes for May week 3. This is simply rolling out the position to add another month to our expiration. What that transaction resulted in is we bought to close the calls, the April week 3 calls, for $3.40 and sold to open the May week 3 calls for $3.20. So it cost us 20 cents to complete this transaction. There's a 20-cent cost of management to have the privilege of having an extra 4 weeks to expiration. It gave us a lot of time to be able to wait for the next down cycle and or manage or adjust the trade again. A week later, we were able to then close on a down cycle the May week 3 calls for $2.20. We paid back $2.20. So we actually nudged right up against what would have been April week 3 expiration. We might have been okay if we'd held, but we don't like to hold our breath and hope that trades are going to be okay. We just simply bought more time and gave ourselves the luxury of being able to make any decision we needed to on that trade over an additional 4-week period. Rolling it out just allowed us to hold and wait for the next down cycle. So the summary of this trade is that it was in play for 14 trading days over 2 weekends. I'm sorry, 14 trading days, 18 calendar days over 2 weekends. We ended up with only a $468 profit, but when I say only, let me emphasize, it was a profit. We had a position that was threatened. The index moved against our strike. It was in the money. We didn't have to worry about being exercised or assigned because it's a European style expiration. We ended up making a net positive profit, spendable money of $468, which was 78 cents on 6 contracts that we were trading. So it's a 15.5% return on our 5-point spread. At the end of the day, we didn't end up with as big of a profit as we thought we might have initially. We ended up giving back a portion of our profits so that we could end up closing out the entire position for an overall net profit. I'm pretty happy with 15.5% over 18 calendar days, and that was a very, very simple approach to managing. Again, opening and closing positions on the cycles. We would much rather manage than worry about positions. I'd much rather make adjustments and have small costs of management than sit here and wring my hands and worry about whether or not it's going to work out. For me, adjustments buy a lot of peace of mind. So here's a chart showing exactly what we did and when. Here's where we opened the Iron Condor, the 4,300 risk strike level, the 44.45 call risk strike level. Here's where the price of the index moved lower and we closed the call. It actually moved below the lower Bollinger Band right here. And so that was our cue to go ahead and take a profit on the call spread. It also moved below our risk strike on the 4,300. But we didn't flinch. First of all, we were not at risk of being exercised or assigned, being a European style expiration. And we saw the Bollinger Band penetration here. And so we anticipated there would be a movement higher, which actually did end up happening. We opened our new call spread here when we were trading at the upper Bollinger Band. And this is an example of how sometimes the price will continue to walk along the upper Bollinger Band or the lower. And so it's not exact, meaning it doesn't bounce away immediately when it touches the band. This is just part of the reason that we build a forgiveness factor into our trade. It moved along higher enough, higher than our 4,400 and long enough that we were starting to run out of time. And so we decided to go ahead and roll it out, which is what we did right in here. And then it was when the price moved lower that we decided to go ahead and exit. Now we gave back $2.20 of credit on that trade. Some people may ask, well, why didn't you hold on and wait for a bigger profit on that trade? And the answer was simple. We saw the price move below the lower Bollinger Band, and that told us that it was most likely going to bounce back higher, which it did end up doing. So we went ahead and took our exit. So the art of trading really is about leveraging the cycles. It can be as simple as leveraging them based on Bollinger Bands, especially if you're just starting out. It's a great approach for new traders, and it keeps things very simple. If you build a forgiveness factor into each trade, again, it keeps things simple. It helps you be wrong, but perhaps still be profitable. And make sure you give your position time so that you avoid that roller coaster fear and anxiety experience that so many traders have when you're too close to expiration and you also don't really know what to do in order to bail yourself out of that trade. This really is very simple trading. It can be this simple. So let me just share with you a program that we have if you have an interest in getting involved in what you've heard. Let me share this with you and then I'm going to take questions. We have a program called the Profit Builder, and we would really like to help you learn, simplify, and enjoy your trading while growing your account. So we're offering a chance to participate in the program. And we started this program based on our live trading room trades. Now, this is not an offer to participate in our live trading room. If you have an interest in that, shoot me an email and I'll share with you what the opportunity there is. This is a very simple program that helps traders kind of get started in the right direction. We help you thread the needle so that you really know on a day-to-day basis what to do. We started this program initially allocating $5,000 of trading capital. All of the trades that we place in the Profit Builder program are placed in a live capital account. These are not hypothetical trades. These are not paper trades. This is live capital. This is real money. We started with risk of $5,000. We were willing to put as much as $5,000 into the total accumulated risk of the positions that we opened. And generally, we're going to have somewhere between 3 to 5 positions open. As you're just starting out with $5,000, it's probably 3 to 4 positions, 3 to 4 contracts per position. We compound profits each week into new positions. So if we made $600 in the first week, the next week we're willing to put in as much as $5,600. It doesn't mean that we will have $5,600 at risk. It just means that that would be our maximum allowable risk. And when you start learning how to manage your account from a maximum allowable risk perspective, you're going to have much greater peace of mind because you will not exceed your risk tolerance. We compound for 1 quarter. We continue to compound profits throughout week by week for 1 quarter, and then we reset at the beginning of a new quarter. So let me just share with you how we've done. We actually started the Profit Builder program at the beginning of the 2nd quarter of this year. We had a live account balance of $11,000. So we want to have more than our risk balance in the account, but we had $11,000 in the account and we started with risk of $5,000. So of the $11,000, we were willing to put $5,000 of it into 3 to 4 positions. We compounded profits each week. And so we've just, as of last Friday, completed the first 30 weeks of the Profit Builder program, and our total accumulated profits are $19,147. Now that's all based on recycling capital. 100% of the trades were on NDX, SPX, and RUT. They're all credit spread trades, sometimes iron condors, sometimes individual spreads. That is the profit that we've accumulated in a 30-week period. Now, before I'm even asked the question, let me tell you, we only measure our profits after fees and commissions. So that is a number that is net after fees and commissions. Now, the other thing is we're very transparent. I told you this is a live balance account. It's a live cash account. So every week on Friday, I show what the actual accumulated wins or loss for that week are, and you see it right in our trading account. And every week you're able to see that. And then we keep a very simple spreadsheet week by week to track what our accumulated profits and losses are. So it's a 458% return against the $5,000 of initial risk. If we project out to the 1-year anniversary date of the Profit Builder program, projected profits right now are saying that we could potentially have profits of $81,000 against our original starting risk of $5,000. We really try to keep it simple, and we consider it to be a very powerful way to start small and grow big. There's no guarantee that we're going to continue to progress at the same performance rate, but we just take it one position at a time, one day at a time, 1 week at a time, and we let the market dictate to us naturally what we will take as profits and losses. So if you're interested, here's what the Profit Builder program includes. It's a 6-month subscription. 6-month subscription. During that 6 months, you will receive emails for the same trades we are opening, closing, and managing every day in our live trading room. Now, not 100% of the live trading room trades, but the trades that are appropriate for the Profit Builder program. We specify for you the exact strikes, the expirations to use, the number of contracts we're trading, and we tell you what our position was filled at, what credit we were filled at. And we give you a range that you should place this trade to a credit of X. So it's within a range of what we filled at. So sometimes you get filled right at what we got filled at. Other times you get a more favorable fill, and other times you get a less favorable fill. But we give you a don't go lower than this particular credit. If you're not available immediately for the email, don't worry about it. The types of trades that we're choosing are not trades that always move immediately in price. Sometimes our clients are actually able to open the exact same trade we did the following day because they weren't able to get to it when we sent out the alert. But here's what I think is the meat of the Profit Builder program. If you really have a passion for learning and becoming a proficient trader, included in the Profit Builder program is a daily 15 to 30 minute education video with an in-depth analysis of each position. We also talk about the charts for NDX, SPX, and RUT. We talk about the management of positions when necessary. We walk you through the execution of the position. We walk you through how to work the trade and get your position filled. We basically give you a 15 to 30 minute education every day, 5 days a week for 6 months, which is, in my opinion, one of the best ways to learn because you're learning through all of the different market conditions that exhibit themselves over a 6-month period. So that's 15 to 30 minutes a day for 6 months. And I think it's a great opportunity to compound your account for each quarter. So the regular price of the program is $1,295. We're actually offering it for $595 for the next 24 hours. I think this is a phenomenal price. I wanted to make a special offer, especially for the Chaikin community. Mark Chaikin is such a great partner and does such great work in helping traders really learn how to identify those trends that will help you be successful. So I wanted to get it to something less than $100 a month for a 6-month period. So here it is, $595 for a 6-month subscription, and that price is good for the next 24 hours. If you're interested, it's optionsmoneymaker.com/builder to sign up, optionsmoneymaker.com/builder. That will take you to a sign-up page. If you have questions that I might be able to answer for you, if we don't get to them today, or something you think about later, feel free to email me, markd@optionsmoneymaker.com. Now I'm going to leave this slide up. You can jot down the optionsmoneymaker.com/builder. You can also jot down my email address, markd@optionsmoneymaker. I'm going to see what kind of questions we may have here, and I'll do my best to answer as many questions as I can. All right. Question is, now that mini DAX is starting next week, can you trade with this strategy? Well, I'm going to assume on the surface that I can. but that you can, but it's not something that I have traded. And so I'm going to just reserve my comment and say, I don't know for sure. I'm fairly certain that you would be able to, because this strategy can be traded on anything. It can be traded on stocks, it can be traded on ETFs. I'm assuming there's no reason why you can't trade it on the DAX, but I don't know for sure, because what I'm intimately familiar with are the three indexes that I talked about today. Question, if your broker does not allow spreads on indexes, RUT, NDX, SPX, can you get the same results with ETFs? I think you could, yes. The dynamics are a little different because it requires more contracts to get the same, dollar value. But yeah, in principle, absolutely you can do that. You don't have the benefit of the European style expiration. I don't want to be cavalier about this, but I would say find a different broker. That's what I would do, first of all, because most brokers do allow them. There are some brokers that do not allow them in IRAs, but you can check around and use a broker that actually would let you trade the way you want to trade. Let's see. Great presentation. Thank you. Appreciate that, William. You mentioned your settings for the Bollinger Bands are 2 and 3 standard deviations. Do you use a 20-day time period for your settings? Yes, it's 20 days. 20 days. That's actually the default in the chart package I use. You mentioned a live trading. What do you do during the day? I'm assuming you're asking what we do in the live trading room, Kim. The live trading room incorporates all of the different strategies that we use and teach at Options Moneymaker. What I profiled for you today is the credit spread strategy in Iron Condor, which I think is an excellent way for people to get started. It's an excellent way for newer traders to get launched, have a little hand-holding, and it's an excellent way for more experienced traders who aren't achieving the level of success that they want to kind of reacquaint themselves with success. But in our live trading room, we trade also long vertical spreads, we trade calendar spreads, we trade diagonal spreads, we trade double diagonal spreads, and we have some number of credit spreads we trade much more aggressively. We do some more aggressive management in the live trading room, and our percentage returns overall, having started with the same $5,000 on the same time period, are much bigger. But it just requires an advanced understanding. So if you do consider yourself to be an advanced trader and you really do understand what you're doing, then feel free to reach out to me, and I'd be happy to share a bit more about our live trading room with you. All right. When are your text emails sent each day? Whenever we have a trade to alert. We are not restricted by a particular time of day. When there is an opportunity, we take that opportunity and we send out the email. But I have two comments about that. One is, it's best to place the trade as soon as you can when you receive the email, but it's not always necessary for it to be done immediately. I can place a trade today and I could get $1.50 of credit, and 3 hours later somebody gets $1.45 of credit. Well, that still is a very reasonable trade. Next day, that same trade might be able to be placed for $1.60 of credit. That's not always the case, but I advise people, don't get bogged down by or hung up by maybe not getting the trade immediately. And frankly, if you miss a trade or two, I don't consider that a big deal either. The first 6 months in the Profit Builder program, your number one objective should not be about maximizing your profits. That may sound a little contrary to you, but I think your number one objective should be learning and understanding how to think like a trader. And if you have a trade that comes across that for whatever reason you missed, Well, follow along with the trade anyway. You might not have it live in your account, but follow along with it because you're going to learn something from it. And if at the end of 6 months you have learned a lot more than what you started out with in terms of your understanding, you're going to move much closer to trading independently, and then you won't be dependent on a email trade alert. Kim's just asking to clarify, do you give out trade entries and the participants can follow? Yes, that's exactly what we do. If we identify a trade that we think is appropriate for profit builders, we execute that trade, and within a couple of moments, we send out the email and we specify exactly what that trade was so that you can also choose that trade and follow along. What kind of account do you need to conduct these trades? Is a regular stock account sufficient? Example, IRA. John, it's best if you have a conversation with your broker and ask them. What you should tell them is you want to trade spreads. You want to trade spreads on the major cash settled indexes. And then they will tell you what kind of account authorization you need. But it's just a matter of getting the right approvals and understanding that you have the right authorization trade. It's not a big deal. People do it every day. What is the losing percent of trades? Presume all trades are not winners. Absolutely, not every trade is a winner. Not every week is a winning week, but it is the end of the week that is the only report card that we care about. We don't care how many winners and losers we have. We don't measure win-loss ratio. That's actually, in my opinion, after doing this for 30 years, a very misleading indicator. We only measure our pure profits or losses at the end of each week. And we simply record them in a spreadsheet. And because we are fully transparent trading a live cash account, in the daily videos, you see what the performance of the account is every day. And you know if we took a loss, you know if we took a profit, and at the end of the week, we actually pull up the performance tab in our trading platform and we see what our net profit or loss for the week was. We don't measure the number of trades. We don't measure how many of those were winners or losers. We don't really care. All we care about is spendable profits at the end of the week. And we transfer those into our spreadsheet and we just keep a very, very simple running summary in our spreadsheet. But we have losing weeks. We have losing trades. If we have losing weeks, we also don't care about those as long as we have a accumulation of winning weeks. So that's how we keep track of it. If you want information about our live trading room, just shoot me an email, markd@optionsmoneymaker.com, and I'll have somebody be in touch with you. Are we using Thinkorswim? No, I actually trade on Option House, the old Trade Monster platform, which merged with Option House. It's a very simple trading platform, very easy to use, accommodates all the types of trades that I want to trade, and very easy to execute. All right. Okay, let's see here. Just the last couple of questions here. There's a question out here about, some period of time that somebody is particularly busy and, they're interested in joining, but they're concerned about being away, certain time of the year. That's really not an issue for us. Because this is a 6-month program, we realize that people like to go away. People might have job or business commitments. And so if you contact us before you leave, we'll actually suspend your subscription while you're gone. If you're going to be gone for a month, I had somebody the other day call and say, "Hey, I'm going on a month-long cruise that my family's dragging me along on. This person really likes to trade." So we just suspend your subscription for that time period, so you get the full benefit of 6 months, even though there may be a break in that period of time. And the last question, and then we're going to call it a night, and I'm going to share something with you here, is the spreadsheet available for examination? That sounds very serious here. So we actually share our spreadsheet with everybody on a weekly basis, and it's really very, very simple. In fact, go out to YouTube and look up Options Moneymaker, and you'll be able to see a weekly profit builder performance summary I do every week that we post on YouTube. When I say we are full disclosure, full transparency, I mean it. We're not shadowing anything here. So here's my $11,000 starting balance. Here's my very, very simple spreadsheet. Here's our $5,000 starting risk. And here are, in this column right here, just to make it simple, here are the accumulated profits and losses on a weekly basis. So we had a loss the week of May 4th. We had a loss of the week of June 15th. And here's our $19,147 of gains to date. That's our total accumulated compounded returns to date. Now, let me just talk about August 24th, because we talked about that when we first started out. Prior to August 24th, we had accumulated about 19,000. Sorry, prior to the week of August 24th, we'd accumulated $18,000 of profits. We got into some turmoil in here because of what happened on August 24th. We navigated our way through that. We took a profit one week, took a loss one week, had no profits, had a loss, had a profit, et cetera, et cetera. We had a big profit the week of 10/5. We had a loss last week, but you net the 2 weeks together, which is exactly what we were managing to, and we were net positive. So all in all, if you look at pre-August 24th, we were at $18,000 of gains. Now that we have navigated our way through all of that unexpected and surprise activity from the unprecedented move on the 24th, we actually increased our profits by another, roughly $1,100. So whoever it was that was asking whether or not it's possible to examine the spreadsheet, absolutely you can do that, because it's out on YouTube. So I think that's all the questions. Let me just put this back up here. If you're interested in our Profit Builder program, optionsmoneymaker.com/builder, and Mark D at Options Moneymaker. Let me just do one last quick check. Appreciate those of you staying with. I know we've run over a little bit here. Just trying to address all the questions I can. We do not auto trade, so we would prefer to teach people how to trade and have them be independent traders. We do not auto trade. If you do send me an email and ask me about that, I can steer you to a broker who will help you trade these. It's not really auto trading, but a broker that's followed all of our trades for the last, ever since we were around, since we started in 2009, and follows every one of our trades. Michael's asking, do we provide the spreadsheet to you? Yes, it's part of the package. We give you a shell of the spreadsheet, and you can track all of your trades. We give you the template from it. Will there be new positions placed each week? We place positions whenever we feel that there is opportunity, when we see the price at the upper or lower Bollinger Bands, or we see an opportunity to open an iron condor. We are not restricted by placing positions time of day or a certain number of positions a week. It doesn't matter. We might have a whole week we go through with no trades. hasn't happened yet, but it could happen. We have days where we could do 4 or 5 trades. It just depends on whenever the market offers an opportunity. And now finally the last question, how is compounding done? Compounding is really simple. If you start with $5,000 of risk that you're willing to put in the market, and you have $600 of profit in the first week, the next week, then you are willing to put in $5,600 of risk into the market. If you put $5,600 of risk in that week or up to that amount, you don't have to be at that amount, and you make another $300, the next week you're going to be willing to put in as much as $5,900. So you continue to do that throughout the quarter, and then you start over again the next quarter. So I'm going to put the link out here. Someone asked for that. And send that out there. So hopefully everybody sees that. It is optionsmoneymaker.com/builder. All right, thank you so much for being here. Really appreciate it. Hope to see some of you in our Profit Builder program. Would love to help you if it makes sense for you. I realize we're not right for everybody, but those of you who have an interest, we will do our best to help you learn how to trade successfully and navigate through what can sometimes be very challenging markets. So thanks again. Have a great evening, and we will talk to you again later. Recording of this will be sent out to everyone tomorrow.